G'day, my name's Ben Everingham and I'm the director here at Pumped On Property, and in today's video I'm going to talk about should you put down a 20% deposit. So this is a question I get asked all the time, and it's really important question in relation to how much of a deposit you should put down on your investment property or your own home. So there's different people with different ideas on this in the market, and obviously take what I'm saying today with a grain of salt. If it's your first time to my YouTube channel, welcome. I'm really excited about today's video, and it would be great if you could subscribe so that you can receive some other great videos from us. I'm going to talk about why deposits matter and the real estate cycle in general. I'm going to talk about the positives and negatives of a large deposit, as well as the positives and negatives of a smaller deposit. And then I'm going to talk about your phase as an investor and why at different phases of your journey, you'll put down different deposits. So the reason for me, or the first thing that I wanted to touch on, is why deposits actually matter. So during my 8-year journey as an investor, I'm 32 years of age now. I bought my first 2 properties in New South Wales when I was 24 after I finished university. So at the time when I first came out after the global financial crisis, the banks were asking for 5% deposits, which for me as someone who was uneducated at that time was happy days. As a 24-year-old living at home, I wasn't thinking too much about risk or the future or the potential downside of putting down smaller deposits, which I think about a lot more now. So, you know, that was 8 years ago. I could put down a 5% deposit. Now, fast forward to 2018, at the time of recording this video, the banks are asking for between 10 and 20% deposits in Australia. New Zealand's just had a policy change where the banks went from lending 10% deposits up to now they're asking for 30 or 40% deposits off investors over there. And there's parts of South America and Africa where you need cash to actually buy property outright. So what I'm trying to say is that at different times of the cycle and in different countries, policies change. Just because the banks are asking for a 10 or a 20% deposit now doesn't mean in 5 years' time they won't be asking for a 5% deposit for a property or a 50% deposit. You know, that is the game. Sometimes money is very easy to access, sometimes it's very hard to access, and as investors we just have to ride that roller coaster based on what the government as well as the banks are saying to us. So in terms of the second thing I wanted to talk about, which is the positives and negatives of a large deposit. So the positives for me for using a large deposit is obviously you avoid lender's mortgage insurance, which can be a significant cost on an expensive property on the property. Generally, you pay lender's mortgage insurance if you have anything less than a 20% deposit, unless you're one of those special people like doctors and certain professionals that don't have to pay lender's mortgage insurance for anything above 10%. So at the end of the day, unless you're one of those special people like doctors and certain other industries in Australia where because the jobs are secure and because they're high paying, their lender's mortgage insurance fees reduce, and generally they can get away with only putting a 10% deposit down and paying lender's mortgage insurance above that. So you know, lender's mortgage insurance is a big cost, and it you know, puts some people off. There's a business case for paying some lender's mortgage insurance from my perspective. We'll talk about that in a moment. Another positive associated with a large deposit is it improves the cash flow position dramatically on the property. Because let's say, for example, if you were to go out and buy a $500,000 property, and if you were to put a $100,000 deposit down, all of a sudden you only owe $400,000, but if your rent on that property is also $500 per week, it means that the cost out of your pocket on a weekly basis is less, and that's always important as an investor. The third positive from my perspective, and the big one, is it reduces your risk. So if the marketplace was to correct, and we've always got to remember that at certain times of the cycle prices go up, prices go flat, and prices go down, or at least that's been the history in Australia for the last 200 years, and I don't see that changing too much in the future either. So it does reduce your risk, particularly at certain times of the cycle, so it can provide you with a bit of a buffer and you know, not freak you out when we go through those quieter stages of the cycle where property prices might drop for a while. Some of the negatives associated with a large deposit are obvious. It is really, really difficult to save 20% on a $500K or $1 million home. It can also stop you entering the market as well. So it's not just about the pain associated with saving or using equity to go put down a 20% deposit. And again, I know a lot of people watching this video would have great equity in their homes or their investment properties right now, but it's not just the pain associated with the saving, it's also the time that you're out of the marketplace. So it could take someone 2 or 3 years to save a 20% deposit if they're just getting started in their journey. And think about, you know, what can happen in the right market at the right time over a 2-year or 3-year period while you're saving that money. You could potentially miss out on, you know, over $100,000 worth of gains on the right property in the right market over that period of time. So there's some of the negatives associated with a large deposit, although there's also a lot of upside. In terms of a smaller deposit, which I was a really big fan of when I was first getting started, not as much of a fan now that I'm more in the consolidation phase rather than accumulation phase of my journey, which I'll talk about more in a moment. But some of the positives with a smaller deposit is obviously you might have that equity already in your property. It's much easier to save. The banks in Australia still seem to be open, or a lot of them seem to be open to lending with only a 10% deposit. So it enables you to get into the marketplace faster. And if you're in that accumulation phase and it's the right time of the cycle and you're investing in a smart, high quality house, you know, close to the beach or close to the city in Sydney, Melbourne or Brisbane, and you're buying a property at the right price, at the right time, with the right upside potential, then a smaller deposit is, you know, not a huge deal from my perspective for me personally, or I will still use those deposits to enter the marketplace, even though they might be a bit smaller and my risk might be a bit higher. You know, I back myself to buy well and to add some value to the property to reduce my risk very quickly anyway. So some of the negatives associated with the smaller deposit is always that risk or that downside. It can also hurt your cash flow because, you know, there's a larger gap between the rent you're receiving and the costs associated with holding the property. So it can stop you moving forward with other banks, can stop you moving forward and buying properties. It reduces the number of lenders that you've got to work with. Some of the lenders go from top tier, you know, the top 4 banks to 2nd and 3rd tier lenders. So there's all of these things that you've got to consider. One of the things that I did want to talk to in regards to how much of a deposit, or should you put down a 20% deposit, is in relation to timing of the cycle. So I think it's very dangerous to buy at the top of a cycle. There's a great report which you can follow on a monthly basis, which is released by a company called Heron Todd White. You can just Google HTW month in review report and you can actually just download that for free, and it will give you a really good update of where the big cities and big regional centres are at right now in Australia on a month-by-month basis, and you can look at previous months and see how things change. But buying at the top of the cycle or buying at the declining phase of a cycle can be really dangerous. So if you're unfortunate enough to buy at the top, to be forced to sell quickly and to go in with a low deposit, it can just hurt your position, and that's where people can come unstuck. The flip side of that is if you're buying at the bottom of the cycle, you're buying a property with some potential, you're buying at the right price, and it can enable you to enter the market at the right time with less money down, which means you might have a 20% deposit, but instead of buying 1 property, you go and buy 2 and, you know, really manufacture some value over the course of a cycle. So cycles are important. One of the things I forgot to mention about how much of a deposit you should put down around lender's mortgage insurance is there's these amazing thresholds in lender's mortgage insurance. And so let's go back to your $400,000 example. Let's say you would have put down a 10% deposit, so $40,000. You might have to come up with, again, I don't have the calculation in front of me, I probably should have prepared it, but say $6,000 to $10,000 worth of lender's mortgage insurance, depending on which bank you're working with. If you were to put down slightly larger deposit, maybe 12 or 13%, all of a sudden I've seen this threshold point where lender's mortgage insurance can be dramatically lower. So that might mean that instead of paying $6,000 to $10,000 lender's mortgage insurance, you put down, you know, an extra $10,000, and all of a sudden you've saved yourself, you know, somewhere between $3,000 and, you know, even some instances $5,000 or $6,000 on lender's mortgage insurance. Now, The other thing about lender's mortgage insurance is it's not one of those things to stress on. Most of the time you can add it into your actual home loan, so you don't have to cough that money up yourself as well. The last thing I wanted to talk about really, or two last things I wanted to talk about is where you're at as an investor. So when you're in the accumulation phase, and I've done more videos on this sort of stuff, the 3 phases as an investor that we all go through. When you're in the accumulation phase, it's really the stage where you are going out and buying high quality properties that in the future will be worth more than they are today to really set your own financial independence up. Now in the accumulation phase, one of the important things to do is to accumulate the properties now that 15 years from today will be worth enough for you to maybe sell 1 or 2 of them and to pay off a couple of other properties outright, therefore giving you cash flow for life. And I've done a really cool video on this titled 4 Properties to Financial Independence, which explains these stages and a pretty easy process to follow to really get yourself in a good position within 15 years. But during that accumulation phase, you know, when I was going through that phase, I was putting down 5 and 10 and 15% deposits because I knew that the sooner I owned properties, the longer I could hold them for, the higher the likelihood of the value of the property going up, and therefore the better position I'd be in the future. Now, most investors don't accumulate at the right stages of their life. They don't do it early enough to give themselves 15 or 20 or 30 years for the value to really go up, and that's, you know, why most people don't achieve financial independence, unfortunately. The second phase is consolidation, where you've bought all the properties, you've got a good income, you've got a good cash flow position on the properties that you own. You're really in debt reduction phase at this stage of your journey. You know, when you've got some good properties that you've held for a while that have good equity, during the consolidation phase, you know, most investors I know put down that 20% deposit for all of the positive and negative reasons I mentioned before. So the last thing I wanted to talk about is, you know, don't take this advice on board without going and speaking to a mortgage broker or a financial planner. I'm not licensed to give you actual advice in relation to your situation. These are just some general ideas that I have around deposits. Obviously, go talk to your mortgage broker or financial planner, get their perspective on this stuff. And if you're in a strong financial position, sometimes it's really smart to put down bigger deposits. If you're just starting out, sometimes unfortunately you're forced to put down smaller deposits. In an ideal world, everyone would have 20 to 50% of the value of every property they ever buy to put down as savings. But you know, I understand that we're not all in an ideal world. We're not all at the same stage of our journey, and 99% of us weren't born with, you know, here's a gift of $1 million from mum or dad to really jumpstart the journey. So it is a process. It's definitely something worth thinking about for your situation. Good luck with everything. For those of you that are in a position to consider buying a property in the next 12 months, I'd love the opportunity to catch up with you for a one-on-one strategy session. I own a buyer's agency called Pumped On Property that helps people buy very high quality properties at really good prices. We help 150 odd clients a year buy great properties and really set themselves up for the future so that they can achieve financial independence and they can get that choice back in their life. If you want to go over to my website, www.pumpedonproperty, and book in a complimentary strategy session, I'd love to talk about where you are and where you want to be in the future and how we might be able to help you bridge that gap. So thanks for your time and attention, and have a great day.